Hey everybody, it's Pete Carmesino here again. Thanks for tuning in. Hey, look, just want to go over what's happening here out in the markets. I'm just, pre-gaming here for the week. It's Sunday night. I'm just putting this recording together to go over a few different things. So, welcome back. We want to talk about obviously what's happening in, December here after the Fed meeting, the latest cut, and why the message kind of felt a little messy because based on data, I mean, we're not exactly sure what's happening here with jobs data and a lot of the things that are happening, how things are being collected. Powell himself said, some of these surveys may not be reliable. People aren't answering the surveys for unemployment and things of that nature. So, look, there's always going to be uncertainty, and now we've got uncertainty in the data. It's not a fun time, really, to kind of be crunching data only because we don't really have a lot of this really hammered out yet. Obviously, with the government shutdown, a lot of things changed. There were some changes to the BLS and a lot of different parts of the administration there. And so there's a lot of moving parts right now, and you really just need to look at price action right now. Try not to misunderstand a signal instead of noise. In other words, I saw something yesterday. I put out the trigger for the QQQs over the consumer staples. When you start to see the Qs underperform versus consumer staples, I'm saying that's something, that is a signal. Is it noise? Maybe. But right now, I don't see it as that. I see it as something on my radar that I'll be watching very closely and just kind of try to understand what's happening out there in bonds, right? With interest rates, they're inversely correlated to bond prices, right? So as bond prices rise, rates drop and vice versa. And so are bonds becoming the safe haven again? It's been sort of the jury's out, so to speak. And bonds have done that for a long, long time. They're always a safe haven. 60/40 portfolios, have done very well for many years up to 2022, and then things changed. And so we've got a lot going on. And when you're putting a portfolio together, whether you're a swing trader or a long-term investor, look, you're always going to face uncertainty no matter what it is. And so now we've got different types of uncertainty, right? So we've got data uncertainty, forecast uncertainty. The implied market expectations have changed based off of data that may not even be correct. And so there's, again, part of this market understands that the volatility is creeping in to portfolios across the board. And don't forget, this week we've got quadruple witching, we've got CPI, retail sales, jobs data, and that's all hitting into year end with the seasonality, hopefully as a tailwind from the Santa Claus rally, so to speak. People have been using that phrase for so long. It's just funny to say. But my point is, the big picture is the U.S. equities are deep into a bull run off the October 2022 lows. The S&P is up strongly year to date, over 15% or so, roughly, give or take, a few points one way or the other. And we are entering into basically the final full trading week of 2025. So this is all coming as we walk into a week that's going to be dense in macro data. Again, delayed jobs data coming out, November CPI, and obviously key reads on retail sales. Now, Black Friday and all of what we're hearing were pretty strong. So that should be interesting. But here's what I'm looking at. This isn't going to be a sleepy pre-holiday week. This is where the tape has to digest a year's worth of positioning and a month's worth of macro data in just a few days. And so let's take a look at what I'm seeing out there. I'm looking at the Qs again. I'm looking at the dollar index, how that impacts some of our stock indexes. And I'm looking at the 10-year yield, but I'm also going to look at growth over value. So let's dive onto the charts right now and take a look at what I'm seeing. Okay, so here what I have is a three-panel screen. Up here is the NASDAQ 100. That's the QQQs. You got the US dollar index in the middle, and you've got the 10-year treasury yield here. So look, the correlation will change, and then it will flatten out and almost be, non-existent for some periods of time. But the interesting part is, as you can see where the COVID level was here in 2020, we sold off with a big V-shaped recovery, thankfully. You can see where the dollar was trending lower and rates were basically kind of unchanged to a degree for 2020, that is. And then into 21, rates started to move higher. Why? Well, because bond prices were selling off and the Fed was very, very late with the whole transitory nonsense that they were talking about. Now, look what happened with the dollar. Once the index started to understand what was taking place out there in the bond market, the dollar started to rise. When the dollar rises, what happens to other currencies? They fall. So, what happened to our stock market? It started to roll over because of the inflationary data and the pending Fed rate hikes that were coming in March of 2022, and they came. And that's exactly what happened. You saw rates continue to move higher and the dollar moving higher. Because look, as our dollar denominated assets have higher interest rates, there's more demand for those assets, and obviously you're starting to see folks take advantage of that. And so, look, I'm looking at this entire week and trying to understand what's happening. Again, this isn't just another turn of the calendar page here. I think it's a stress test of how much good news is already priced in and how dealers are going to be positioned into year end and whether seasonal tailwinds can overpower macro uncertainty once again. And so let's talk about this core thesis. Look, when the dollar falls, global investors, their risk appetite often improves because the dollar strength is frequently associated with tighter global financial conditions. And so, at the same time, a weaker dollar can mechanically raise reported revenues and profits for the U.S. multinationals. Again, when foreign sales are translated back into U.S. dollars, which can also support not only the S&P 500, but also the QQQ, a lot of the overlap, obviously, between those two indexes. And so if foreign investors respond by reducing U.S. dollar exposure or increasing their own foreign exchange hedges, the act of hedging itself can create a persistent dollar selling, so to speak, pressure, and it reinforces the dollar downtrend while leaving sort of the underlying equity demand intact. And that's exactly what we're seeing right here. The dollar selling off, rates stabilizing. Okay, the correlation kind of unhinges, so to speak. This was the tariff sell off quickly. Again, another V shaped recovery very quickly, broke the new highs and continued higher. Now I'm going to zoom out a little bit. I'm going to lose the title of the chart, so bear with me. If I zoom in, I meant. When I zoom in, I can start to see we just couldn't get to these higher highs. That's not so much a terrible thing, but at the same time, you certainly don't like to see that, especially in a market that's been so hot on the upside. Now, the downside is going to be somewhere around 5.8. It looks like support on the Qs. The dollar right now is sort of trending lower, and rates are trending very ever so slightly higher, but really not when you again zoom on this chart, you can see this is pretty much a flat trend on the U.S. Treasury yield. The dollar, though, is definitely on the downside. It's going to have its ebbs and flows moving up and down, but predominantly to the downside. And so, as I said, again, if foreign investors are going to respond by reducing exposure and they start hedging, this is basically, could help create a persistent dollar pressure to the downside. And so that's what I'm seeing. So let's take a look at what you'd like to see as far as growth over value, just to take a look at that chart before we call it a night here. Okay, as I promised, I said I'll look at the Vanguard Megacap growth over Vanguard Megacap value. Again, understanding a ratio chart, the direction of this is really going to be the direction of Megacap value, growth, showing that growth is outperforming on the upside. Now, when this chart starts to roll over, that means value is starting to outperform growth. And that's what you've seen really since December 9th, again, which is only less than a week or so from tonight. And what's happening here? It's the same setup, right? Growth has been obviously outperforming, but value is starting to catch a bid due to some fears. But you can see really when this all started back in April, we had the sell-off, rebounded here. You started to see the sort of the ratio move above the 50-day moving average of this ratio. And then it was really just moving higher ever since. Once it broke out of the new highs, it obviously put in some new levels to the upside. Now, the problem, is that this is starting to, I would say, underperform, so to speak. But that doesn't mean, you know, growth isn't moving higher. It just isn't moving as high as value. So can we get a slowdown? Absolutely. Is it a trigger to do anything rational or irrational or impulsive? Absolutely not. And so you just I'm showing you this because this is a really interesting way to kind of, again, take the temperature, look at the pressure gauge, so to speak, however you want to, formulate it, so you can understand it. This is just a sentiment indicator to see what's happening. Again, very short term. It's hard to really look at this and say, yeah, I should be buying here and selling here. No, that's not what this is for. This is more or less to get a gauge of what's happening. You could see the longer term trend is definitely to the upside still, even though we've had this pullback. Now, is this going to be support here? Not exactly sure. No one knows that. But as things start to change, if they continue to the downside, you're going to start to see signs not only in this ratio, but in multiple ratios. And I showed you the other one yesterday, which was QQQ over the staples. When you start to see consumer staples outperforming the Qs, again, the NASDAQ 100, that's a change in trend that you certainly have to pay attention to. All right, folks, thanks again for tuning in. I'll be back to you real soon. Take care.